Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Rivian.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps the channel grow and lets us know what you want to hear more of. Okay, let's just jump straight in here. I was watching the after-hours charts last night, and I honestly had to do a double take.
Right.
I thought my feed was broken. We're talking about a massive move. Wait, over 14% up?
Yeah, over 14%. It's a huge reaction.
And this is in an EV market where, the mood has been so cautious, gloomy even.
Well, that's it. Everyone's been so worried about demand falling off a cliff.
Exactly. The narrative has been, the EV gold rush is over. And then Rivian just drops this and goes vertical.
Yeah.
So what on earth happened? What was the trigger?
It's a classic case of a beat and raise, but a really emphatic one. It all centered around their Q4 2025 earnings report. The headline is they didn't just squeak by expectations. They beat them cleanly, across the board. And in this market, where investors are terrified of cash-burning companies hitting a wall, that kind of execution, it's like a shot of adrenaline.
So let's talk numbers, because a beat can mean a lot of things. Was this a genuine surprise or just, clever expectation management?
Oh, this was substantial. Top-line revenue came in at $1.29 billion.
1.29?
And the street was at.
Consensus was sitting at $1.26 billion, so a solid beat. And if you drill down, the automotive revenue specifically was about $839 million.
Okay, that's a strong number. But I have to push back a little. We all know the headwinds, regulatory credits are drying up, those federal EV tax credits expired. I mean, everyone expected a hit to demand.
And that's exactly why this is so important.
Right.
They faced all that, and they still beat. It shows that the actual organic demand for the product is resilient. They aren't just leaning on government money anymore.
There's real demand. It seems to be. But, while the revenue beat is great, that's not the real story. The thing that has institutional money so excited, it's profitability.
Profitability, the magic word. For so long, the knock on Rivian was that they were just, lighting money on fire with every truck they sold.
Selling dollar bills for 90 cents, yeah.
Is that actually changing now?
It's flipping. And I mean dramatically. Look at the gross profits. In 2024, they had a negative gross profit of $1.2 billion.
$1 million hole.
A deep, deep hole. But for the full year, 2025, they swung to a positive gross profit of $144 million.
Wait, hold on. Let me just process that. They went from losing $1.2 billion to making $144 million.
On a gross basis, yes. That's more than $1 billion swing in just 1 year.
Can you break that down to us? Why is gross profit so important here?
Sure. Think of it like a lemonade stand. Gross profit is what you make after you pay for the lemons and sugar.
The cost of the actual product.
Exactly. If it costs you $1 to make the lemonade and you sell it for 90 cents, you're losing money on every single cup. That was Rivian. Now, they figured out how to make that cup of lemonade for, say, 80 cents. Now they're profitable on the core product.
So the fundamental business of making the truck is now making money.
It is. They still have other costs, of course, but the unit economics have flipped.
Okay, but how? $1 billion swing isn't just cutting a few costs.
No. Cost cutting was part of it, for sure. But the real secret weapon here, the thing a lot of people miss, is software and services.
Ah, the software play. Everyone wants to be a tech company.
Well, the data says Rivian is actually pulling it off, software and services revenues. They surged over 100% year over year.
Wow.
In Q4 alone, that segment brought in $447 million. And the gross profit on that software is incredibly high.
Why is that?
Scalability. To sell another truck, you need more steel, more labor, your costs go up. With software, once you write the code, selling it to the millionth customer costs you almost nothing. It's nearly pure profit. That software profit is now funding their innovation in AI and autonomy.
So they're becoming less of a car company and more of a tech company that happens to sell cars.
That's exactly it. And for wealth building, that is the key. The market values tech revenue so much more highly than auto revenue.
It's a whole different valuation multiple. Okay,
Yeah.
That makes sense. But the market is always looking forward. What's the promise for 2026?
And that was the second punch in the 1-2 combo. Their guidance was aggressive. It really caught Wall Street by surprise. They're guiding for 62,000 to 67,000 total deliveries.
62 to 67,000. What does that translate to in terms of growth?
That's about a 53% growth rate.
53%. in this market.
I know. When everyone else is forecasting flat growth or even pulling back, that's a huge statement.
And I'm guessing that growth isn't just coming from their existing R1 trucks and SUVs. This has to be the R2.
It is the absolute key. This is the R2 factor. Analysts were only expecting about, 13,400 R2 units in 2026, a slow ramp.
And Rivian is guiding for?
Over 22,000.
Wow. So nearly double what the experts thought was possible.
Right. It tells you they're confident in their production lines and their supply chain.
So let's talk about the R2 itself. For anyone who hasn't been following, what is this thing?
Think of it as Rivian's Model Y moment. The R1 vehicles are incredible, but they're expensive. $80,000 luxury trucks.
Right, a niche market.
The R2 targets the mid-size SUV segment. That is the heart of the American auto market, and the price point is key, around $45,000.
Okay, so that's a direct shot at the average family car buyer. It's not a toy anymore.
Exactly. And the early reception has been fantastic. It takes that cool, rugged, premium adventure brand that they've built and brings it down to a price normal people can actually afford.
But that puts them in a Shark Tank. You've got Tesla, Ford, Hyundai. How does Rivian defend itself? What's their moat?
Great question. And they've spent billions building that moat. First is technology. It's their own proprietary stuff. The EV architecture, the RAP1 autonomy processor, the Rivian Assistant. They're not just buying parts off a shelf.
So they control the brains of the car.
They control the brain and they control the heart. They are vertically integrated.
That's a term we hear a lot. What does that mean for an investor?
It means they own the whole pizza shop, not just the storefront. They make their own dough and sauce, in this case, their own motors and battery packs. It's expensive up front, but it gives you control over cost and quality in the long run.
A unique product.
A unique product and better margins down the road. And then you have the Volkswagen joint venture.
How does that fit in?
Scale. Suddenly, when Rivian goes to buy microchips, they're not just a startup. They have the purchasing power of one of the world's largest automakers behind them. That drives costs down.
That's a huge advantage. And I'd say their brand is a moat, too. It's distinct. It has a personality.
The premium adventure positioning. They're selling a lifestyle, not just a car. And that commands loyalty.
Okay, fundamentals look better. Guidance is strong. They have a moat. What is the smart money doing? What are the big institutions saying?
This is where it gets really interesting. If you looked at options activity before the earnings, you saw significant bullish flow.
So big players were betting on an upside surprise.
It looks that way. We saw large institutions buying call options, which means they had a high conviction that good news was coming. It's like seeing a pro gambler place a huge bet right before the race starts.
So they sniffed it out.
It seems so. We also saw whale activity, so large block trades accumulating in the sector around names like Rivian. So while the news headlines were all neutral or cautious...
The money was telling a different story.
Exactly. The money was following the bullish undercurrents around the R2. They see it as the real catalyst.
So for a listener who's interested in the long game, what are the key dates? What's on the calendar?
Okay, get your pen out. There's a clear catalyst calendar for the next 3 months. First up, March 12th, 2026.
March 12th. What happens then?
That's the full R2 reveal at South by Southwest. SXSW, we should get final pricing, specs, all the details. It's a huge stage for them.
Perfect for their brand.
Yeah.
Okay, what's after that?
Late May 2026, that'll be the Q1 earnings report, and the focus there will be all about the R2 production ramp.
So proof that they can actually build it at scale.
Exactly. And then you have the macro picture. If the Fed starts cutting rates later this year, auto loans get cheaper.
Which is a massive tailwind for a $45,000 SUV.
A huge tailwind.
It really does sound like the stars are aligning. But we have to talk about the bear case. What could go wrong?
And this is important. Building cars is incredibly expensive. Capital expenditures, CapEx, are set to double to about $2 billion to launch the R2.
$2 billion. That's a lot of cash going out the door.
It is, and because of that, their adjusted EBITDA loss is projected to be between negative $1.8 and $2.1 billion. They are still burning cash to fund this growth.
What's their cash position look like?
They ended 2025 with $3.58 billion in cash. That's down from over $4 billion the quarter before, so the pile is shrinking.
So $3.6 billion in the bank, and they're planning to burn at least $2 billion just on CapEx, plus operating losses.
Yeah.
That seems tight.
It is tight. They are walking a tightrope. They have enough cash to build the bridge to the other side, but they need everything to go right.
So execution risk is the big one.
It's everything. Any delays with the R2, any factory issues, and that cash runway gets very short, very fast. The market thinks this risk is priced in, but it's absolutely there.
A high-stakes game. Okay, so we've covered the earnings, the software pivot, the R2, the risks. Time for the final verdict. Buy, sell, or hold.
I'm giving this a bullish score of 8 out of 10.
8 out of 10, that's pretty strong. What's the elevator pitch?
Rivian is at an inflection point. The Q4 beat proved they can execute. The 53% growth guidance changes the narrative. And the software profit proves they have a real path to sustainable earnings.
So you're buying the pivot.
I'm buying the R2-driven re-rating. This is the right product at the right time. The recommendation is a buy now.
And the time horizon.
This is not a quick flip. This is a multi-year hold. You're buying to capture the R2 ramp through 2026 and beyond.
Patience is key, but the entry point looks good.
I think so. The 14% pop was the signal. The train is leaving the station.
Well, there you have it. Rivian, pivoting from a cash-burning startup to a software-backed autoscaler. A bold thesis, but the numbers finally seem to be backing it up.
Definitely one to watch. And remember, March 12th, that SXSW reveal will be the next big data point.
We'll be watching. Thanks, everyone, for tuning in to Smart Wealth with Joshua. If this helps you out, hit that like button and let us know in the comments. Are you buying the R2 hype?
We'd love to hear your take.
Until next time, invest smart.